Hey, what's good everyone, and welcome back to another episode of ETFs Explained. If you're new to the channel, my name is Jordan, and I'm the mind behind MakeMoreCapital, the financial education brand that hopes to make everyone a little bit more financially literate. And today we're going to be looking at two real estate ETFs and one real estate investment trust. So we've covered many different types of ETFs before, S&P 500 or ones that track the S&P 500, the NASDAQ, global ones, high dividend yield ones. Now we're looking at real estate. So if you wanted to invest in real estate without taking on a massive mortgage, a couple real estate ETFs or real estate investment trusts would be the right place to look. So first, just to clarify before we start, real estate, what is a real estate investment trust? So a REIT for short, real estate investment trust, is a company that owns, operates, or finances income-generating real estate. So it's modeled after the mutual fund, so either the active or passive mutual fund or exchange-traded fund, but they pool the capital of numerous investors, and instead of investing in companies, instead of investing in equity companies, they invest in companies that invest in real estate. So the key takeaways is that a REIT is a company that owns, operates, or finances income-producing properties. They generate steady income from investors but offer little in the way of capital appreciation. So the idea of this is that a lot of REITs will pay you dividends more frequently, or they will pay a higher amount of dividends or passive income. However, the appreciation over time, so the growth and value of the share price, will not rise as high as you would see in some ETFs that track the S&P or the NASDAQ. Now, most REITs are publicly traded like stocks, which makes them highly liquid. So unlike buying a home where you need to find a seller, you can go on any exchange and buy and sell your shares if need be. But a good thing to know is that they invest in almost all real estate property types. So apartment buildings, cell towers, data centers, hotels, medical facilities, offices, retail centers, warehouses. A lot of the times it'll be residential real estate, commercial real estate. So it's good to know obviously what you're investing in. But so today we're going to be looking at VNQ, which is the Vanguard real estate ETF, and then USRT, which is the iShares Total Core US REIT ETF, and then we're going to look at one individual REIT that you can invest in yourself. And now, so the idea is that a REIT is a company, so there will be no management fee for investing in it. And I don't typically do company analysis too often, so I'm just going to show you some details and just compare the perks as to what you might get by investing in Realty Income Corp, an individual REIT, as opposed to ETFs that would give you exposure to some REITs. So if we look, VNQ from Vanguard is trading at $81.80 right now. The market is open, as it is midday in the market. Now USRT is trading at $45.41 right now, and Realty Income Corp is trading at $64.62. So let's take a look and see what these ETFs are about. So the Vanguard Real Estate ETF VNQ. What is the summary of this product? What is it aiming to do? It invests in stocks issued by real estate investment trusts, so REITs, companies that purchase office buildings, hotels, and other real property. Now, it doesn't really give much detail whether it's residential or commercial. Hopefully, we can find that information as we go. But that is good to know because obviously office buildings aren't being used as much currently at this time. However, homes are still in demand like usual. So you'd want to think maybe it'd be better to get your money more into residential real estate investments as opposed to commercial ones. Now, the goal is to closely track the return of the MSCI US Investable Market Real Estate 2550 Index. So that is the benchmark that it is tracking. It offers high potential for investment income and some growth. So the share value rises and falls more sharply than that of funds holding bonds. So it does tell you that the share price will be fairly volatile compared to bonds, which are the least risky type of investment vehicle. But the main thing is that the high potential for investment income, this is where you get paid the dividends more frequently, and that is more or less the incentive to own a real estate ETF. Because, again, if you want more growth if you want more capital appreciation, you'd best to invest in an S&P 500 ETF or an ETF that tracks the NASDAQ. However, passive income, so if you want to get as many dividends as possible or accumulate dividends more frequently, you would want to look into high dividend yield ETFs or real estate ETFs like this one. And it's appropriate for helping diversify the risks of stocks and bonds in a portfolio. So just as an example, if you had 60% of your investments in stocks and 30% in bonds, you can put that extra 10% in real estate to diversify it a little bit. It's all about having the proper asset allocation. And the expense ratio for this one is quite low. This is the annual fee you would pay. So first thing in an ETF you want to look out for is the expense ratio, which is 0.12, which is quite low. Not nearly as low as some Vanguard funds that track, say, the S&P 500 and others. However, still very, very low and reasonable. Now, again, this category is real estate. Asset class is stock sector specific. And your ETF advisor is the Vanguard Equity Group. This one is rated a 4 out of 5 for the more risk, more reward. But again, the price might see more volatility. The main thing you want to look for is those dividends, how often you're paid them, and therefore how often can you reinvest them. Excuse me. And as we saw, the market price is trading at $80.81. So if we jump over to check out the price and performance, in the last 10 years, if you were to invest $10,000 in August of 2010, your money at the all-time high would have been worth $27,357.66. In March, unfortunately, when things hit their lowest point, it would have dropped to $20,000 or $20,519. However, today it has recovered back up to $24,225. So that reinforces the idea is never sell when you're down, or at least make sure you're balancing the rest of your money well enough that you don't have to sell for a loss, because that is the only way you lose in investing. Nonetheless, it is done fairly well, but you do want to remember that this appreciation takes a bit longer because, again, the growth is not as quick. However, it's the dividends that you are paid for holding this over time that is more or less the incentive. Now, since inception, since 2004, it has returned 7.91%, which is still quite good. Over the last 10 years, 9.26%. Over the last 5 years, 6.41%. And over the last 3 years, it's done 3.26%. However, over this past year, all real estate ETFs have seen a significant drop. So that's why I'm considering looking at them just as a way to diversify my portfolio. But again, if this year you will see that it's been down 8%, 8.7%. However, the dividends will still be paying out. So you will be getting at least some sort of a return in the form of the dividends. But if you were to take the average annual MER of 0.12, subtract this from 7.91, since inception, you'd still be getting 7.79, which, again, is a good rate of compounding over time. So this ETF is certainly stable, and it obviously from Vanguard is one of the more reputable sources. So let's take a look what's inside of it. The number of stocks inside is 181. So it is fairly diversified with a median market cap of $19.1 billion. Now, the price-to-earnings ratio seems to be quite high, though, at 33.1%. However, we'll come back to this one in a moment because it appears there's also a way to measure real estate ETFs, and a better way would be to use the price to cash flow. So we'll take a look at that one afterwards because it displays it a bit more clearly with the BlackRock and iShares ETF. However, I did want to point this out that in terms of a regular price to earnings, this would be quite high. So although the share price has seen quite a drop, you're still not necessarily getting, like, what it seems that there is still a lot of earnings, future earnings, that is already accounted for in the current share price. So that's one thing that I did notice that I would want to look into more. But besides that, it seems like everything else is fairly healthy based on the growth rate of this ETF. And if we look at what it's invested in, again, it's very diversified in other real estate investment trusts. So you've got diversified REITs, healthcare real estate investment trusts, hotel and resorts, industrial real estate investment trusts, office ones, real estate operating companies, real estate services, residential REITs, so it is in residential as well, retail, and specialized. So this one is very diversified, not like a lot of some of the other ETFs where you'll see 30% of it is in information technology. This should give you some confidence as an investor, just knowing that your money is in a lot of different places. If we take a look at the top 10 holdings, so it is invested in Vanguard's own Vanguard Real Estate 2 Index Fund, American Tower Corp, Prologis, Crown Castle International Corp, Equinix, Digital Realty. Now, I don't know a lot of these companies as a Canadian, but the 10 largest holdings does make up 49.20% of the total net assets. So, of course, you would want to take a look at each of these companies individually and go through what they have to offer. But that is basically the gist of what this one is invested in. And let's take a look at the fee again. Well, quickly, we saw that 0.12. So it's significantly better than most other ETFs. However, the distribution, this is the last important thing we want to look at. So the fee is quite low. The average annual return since inception has done fairly well, so you'd still be making over 7%. But what are you going to be getting paid every month? Unfortunately, this one actually does not pay dividends monthly. It pays dividends quarterly. Now, you will be getting a higher amount per dividend, which is great. 75 cents was the last one paid out on June 30th. However, getting paid, you will only be getting dividends 4 times a year as opposed to 12 times a year, which obviously the more you can get paid dividends, the better, but not every ETF will work that way. And so the last few, it does pay, it seems, every June, September, December, and March, but $75 or 75 cents per share was the last one, 64 cents, 71 cents, 55 cents, 62 cents, so it goes down the way, but it does not seem to have missed any dividend payments, which is a very good sign. Now, that is it for VNQ. So again, if we highlight the returns versus the expense ratio, it's quite good. Now let's jump over to USRT, which is the iShares Core US REIT ETF. Now this one is priced at $45.22, so it's basically it's a significant drop in price, so that gives you easier access to get in. Basically, what you can buy for 1 share of VNQ, you can buy 2 shares of USRT with. But let's take a look at the objective of this one. It's a low-cost access to diversified US REITs, real estate investment trusts. It seeks income and growth with broad exposure to US real estate across property sectors, and it's a core portfolio holding for long-term US real estate. Now, I want to point out here, though, that it has not been having a great year. Obviously, year-to-date, since the start, it's been down over 15%. So one thing I would consider when you look at this ETF is just seeing that, okay, it's invested in real estate, and that's always been an iffy topic, especially when markets are at an all-time high. However, you want to take some time to figure out what's inside of it and be able to identify whether this is actually just trading at a very oversold price where you can actually get in and ride it back over time. So an important thing to look at here, though, as well, is the expense ratio, which is 0.08, 0.04% lower than VNQ, which is already a plus in my books. But the iShares Core US REIT ETF seeks to track the investment results of an index composed of US real estate equities, which iShares makes up for us. So let's go look at its past performance since inception, when it was created in 2019, I guess. So it's actually quite new, which is a good sign. But since then, it has returned 3.61%. Hold on, let's take a look. Okay, no, it was inception. It was created in 2007. It's very deceiving when it does that. But since 2007, I think because obviously coming out in 2007, then 2008, 2009 happened. Those were probably very difficult years. And that is why since inception it's so low. But if you look at the past 10 years, it has returned 8% since 2010, which is promising. The last 5 years, it's returned 5.13. In the last 3 years, it's returned 1.27. However, this year, again, it is struggling the most. So again, if we wanted to look at the 10-year average, 0.06, and then we subtract this very low expense ratio of 0.08, you're still getting 7.98% on average over the past 10 years, which is quite good for an investment vehicle. And again, with ETFs, you got to hold long term. Now let's jump over to distributions, dividends, because this is, again, the most important thing. If the MER is low at 0.08, and over the last 10 years, it has returned 8.06%, those are great things that we want to see. So we want to make sure that the dividend is getting paid as frequently as possible, and that we are going to be making enough to reinvest and buy more shares with that dividend income as soon as we can. Now, so it seems it pays them out September, December, March, and June, about 32 cents, 43 cents, 53 cents, 45 cents. So this is something you have to consider. The dividend amount that is paid is a lot less than what VNQ pays. However, 1 share of VNQ is about a little under double of what 1 share of USRT are. So again, you want to just try to figure out what will be best for you, whether you want to be buying shares of the lower cost in order to accumulate more shares to get paid more dividends, or if you want to just buy the more expensive shares that will get you higher dividend payouts. Ultimately, it just depends, but the goal, right, with ETFs is to just accumulate as many shares as you can over time, and that way you are getting paid dividends every quarter, and then you can reinvest those And that is really the goal of ETFs, though. They're supposed to be treated as long-term core holdings too. So this one was the inception date was 2007. The class is real estate. This one has 149 holdings as opposed to 181 with VNQ. And a few other things we just want to look at. It trades on the New York Stock Exchange. The benchmark that this one tracks is the FTSE NA REIT Equity REITs Index. And besides that, I mean, the daily vol, this is all just extra information that you don't necessarily need to pay attention to. However, of course, the more you do this research yourself, it is good to look at. But I did want to point out this price to cash flow ratio. So this is another one that I found, because it's a real estate investment trust, you actually want to look not at earnings, but you want to look at cash flow, what's actually being paid back to the landowners or the people that own the real estate property from the renters. And so price to cash flow refers to, it's the multiple that compares the company's market value to its operating cash flow or its stock price per share to operating cash flow per share. So how much cash flow is it getting basically per share? And going a bit further, it's like currently the average price to cash flow for the stocks in the S&P 500 is 14.5. But just like the PE ratio, the value of a price to cash flow ratio, 15 to 20 is generally considered good. So if we look here again, in theory, the lower a stock's price to cash flow ratio, the better value that stock is. So before I just get too much into that, it's just good to know that the price to cash flow ratio is not in the upper 20s or anything high. This appears that you might actually be getting, like, that this ETF is currently oversold because the price to cash flow ratio is in the lower teens, from 15 down to 10. And just in terms of stocks and companies these days, obviously companies that expect a lot of growth will be trading at much higher price to earnings multiples. But real estate investment trusts, they just want to make sure that they're getting cash flow to pay the rent so that people can keep renting the real estate or their properties out, right? So I think this is a promising thing to look at. Might signal that it's actually undersold. And this actually gives it a rating on its sustainability characteristics, a double B+, which I think is a good sign. But I do apologize, I have not looked into this much, so I don't want to dive into that. And management fee is a fairly low industry standard of 0.08%, which I think is very promising. Again, the main thing you want is a low fee on top of all other factors that scream yes, so that you're keeping more of your money over time. And again, the idea is to hold ETFs long term, 20 to 30 years, buy one share or as many as you can every month until you can let it run on autopilot and just let it do its thing. Now let's take a look at what's inside of this one. Prologis REIT, Equinox REIT, Digital Realty Trust REIT, Public Storage REIT. Now, basically, this is a real estate investment. This is a REIT ETF that invests in a bunch of REITs. And remember, though, a REIT is a company. So I know this can get a bit confusing, and I apologize if I've missaid this a bit even earlier in the video, but a REIT is an individual company that invests in real estate, and a real estate ETF is a single portfolio that invests in many REITs. So I hope that's not too confusing. And a REIT, as opposed to like a stock, it's a trust, real estate investment trust. So that's how it trades and works like a mutual fund. However, it's also on an exchange and trades like a stock. So a lot of technicals there, but nonetheless, the main thing is that with one of these ETFs, you're getting exposure to real estate. And I just want to point out Realty Income REIT Corp. This is a well-known real estate investment trust, and we're going to cover that next, just to go into the details of what you would actually get if you invest individually in a REIT as opposed to investing in a REIT ETF that, again, charges the fee, but again, does most of the work for you as well. So nonetheless, this ETF is very nicely diversified in many different REITs, so at least you know that you don't have to worry about the price just completely dropping overnight. But let's jump into Realty Income Corp, which trades on the stock exchange, on the New York Stock Exchange under the ticker O, and that's Realty Income Corp. So I just want to point out a few things that they spout here on their page, which obviously is attractive for investors, but you want to make sure that you actually look into it. But it's proven 15.3% compounded average annual return since inception on the New York Stock Exchange in 1994. So basically, it's growing at a rate of 15% every single year, which is phenomenal. If you look at some of the past videos where I've covered ETFs that track the S&P 500, you'll see some of them getting close to 13% or 17%. It's not easy to find assets that will pay that, but they do exist. So you do got to dig in order to find them. But also over 7.1 billion in monthly dividends paid to shareholders. This is one reason I would consider investors do think about investing directly in a REIT, which is again a company diversified in many different aspects of real estate, just because they pay dividends monthly. That is a huge bonus to be able to get dividends every month and then reinvest them. Now, just go through a few more of these things that they highlight. Again, 51-year track record of providing dependable monthly income from real estate. So although you can invest in a REIT, a real estate ETF that invests in many REITs for you, the benefit of investing in one directly yourself is huge because you're cutting out costs again. And I think it will give you more exposure and increase the learning or the rate that you're learning. But if we check this out, the monthly dividends, strong shareholder returns. Again, 15.3%. The compounded annual dividend growth is at 4.5%. So the dividend consistently grows every single year as well, probably starting at a very low rate and now being at about, let's take a look. If we go to O stock, so it's a 4.34% dividend. So although it probably started at 1% and it's made its way up, it's paid dividends consistently for 612 or 601 months, which is pretty darn good considering there's only 12 months in a year. It's a lot of consistent dividend payouts, and it's consecutively increased dividends for 91 months in a row, which is great. The properties, though, again, it holds 6,500 plus properties, 600 plus different tenants. It is in 49 states plus Puerto Rico and the UK, with 50 retail and other industries. So this is just a snapshot of some information about like the press releases and what they offer. But in order to jump in, let's take a look at what their top 20 tenants are. So let's see if you've ever been to a property owned by Realty Income Corp. And it'd be like Walgreens, 7-Eleven, Dollar General, FedEx, Dollar Tree, LA Fitness, Rogers Cinemas, AMC Theaters. Now again, theaters will unfortunately be negative affected for a period of time. However, Sainsbury's, Lifetime Fitness, Circle K, CVS pharmacies, a lot of these are properties that were at least deemed essential, which is a great sign to see. And they are well-known brands that likely can afford to pay their rent and will not be going anywhere. And it tells you how many leases they have. So over 248 Walgreens, 403 7-Elevens, $771 Dollar General, $550 Dollar Tree. They own a lot of properties, over 3,000 in total, which accounts for 52.8% of their revenue or cash flow. So I just wanted to point that out to you as well. This is, again, the benefit of slowly diving into looking at individual companies and trying to find good ones, which I myself am doing, trying to get out of, not get out of ETFs, but I have my 2 ETFs that I plan to own for a very, very long time. And then aside from that, I am moving my portfolio more into dividend-paying stocks. But the last thing I wanted to point out is their monthly dividend commitment. So the cool thing about Realty Income Corp is our founders, William and Joan Clark, started with the simple idea to use the rent collected from commercial properties held under longer-term leases to supply monthly dividends to shareholders. And that is what they've done since 1994, or at least since 1994, since they've listed. 601 consecutive monthly dividends paid, 107 dividend increases, that's incredible, 91 consecutive quarterly increases, dividend growth of 211.3% over time. And so if you think about it, you would be getting paid 23 cents a month. So if you're only getting, just to jump over to this ETF again, if you're only getting paid 32 or 43 cents every 3 months, what the benefit you would get of investing directly in a real estate investment trust is you'd be getting a 23 cent dividend every single month. So that's about $2.80 per share every year right now that you own, and clearly over time they aim to increase this. So I just wanted to point that out for you. Similarly, just like investing in any of these ETFs, you would just go to your exchange, or you would just use your broker, log in, type in their ticker, and enter, and that's how you would buy them. So again, though, I do not recommend just investing based on any of this information I've laid out here. Please make sure you do your research. That is obviously the most important thing. But the other thing too is that the one share price of Realty Income Corp is $64.59. So again, let's just do this calculator. I like giving this example. But with $1,000 to start, how many shares of VNQ can you buy? Let's just say 81. You'd be able to buy, oh, nope, that's wrong. Okay, 1,000 divided by 80.81. You'd be able to buy 12 shares, and then with $100, you can buy 1 share a month. If you wanted to buy some of USRT, then, USRT, it would be $45.22, so divided by $45.22 a share. That will get you 22 shares. So again, you have double the share, which will get you double the dividends, but you got to check out the value between the two. However, with Realty Income Corp, $1,000 invested in at $64.59. Whoops. 1,000 divided by $64 and one more time, 59 cents. You'd get 15 shares that will pay you dividends every single month. I think that's a bonus. Now, the last thing I just wanted to point out is most of these REITs this year have fallen from their high. So, like pointed out with VNQ, I know the price to earnings looked a bit high with that ETF. So personally, just based on these, I would consider either USRT or Realty Income Group. But I think you should look at it long term, as in right now you're actually getting a good deal on the share price most likely, because there is a lot more room for it to go up. Then there is room for it to fall back down, okay? There's always room for it to go down if there's a scare, but again, you do not lose until you sell any of your shares, so keep that in mind. But I hope this was a good example. I tried to diversify a little bit out of the ETFs to give you a better idea of some options you have for these assets that do invest in real estate. But let me know what you think about this video. Do you own any real estate ETFs? Do you want me to cover any? Please put them in the comments and let me know what you think, whether these ones are good ones or if you know any better ones as well. That being said, I hope you enjoyed this video, everyone. If you can, please subscribe so that you don't miss any new content. And I will have a new episode of Reality Check Cannabis in 2020 coming out this Sunday as well. That will be episode 2. But that being said, please subscribe, hit the like button if you got some value out of this. I just want to make everyone a little bit more financially literate and provide as much value as possible. That being said, I am a work in progress and I will keep learning as I do more of these videos, but I hope to catch you for the next one, and we'll see you next time. Thanks so much for tuning in.